we've seen this story play out many times where we go right up to the brink, sometimes even past the brink, and then eventually we come to a deal. When we look at this economy right now, I mean, Powell even said the path of the economy is going to depend on the course of COVID-19, and that's going to depend on how consumers are compensated when they can't go back to work due to no fault of their own. So whether it's $600 or $400 or whatever amount they eventually agree upon for that unemployment insurance, that's going to be key. And I think that Washington knows that. They know that those consumers need to continue to produce the demand that is driving the economy. We saw in these GDP numbers, service consumption was down about 45%. So that needs to stay front and center, and it needs to be there in order to keep demand in the economy going, which will help the industrial production numbers as well. That's why I think they'll come to a deal eventually. They know it has to be done.
Victoria, there's a massive problem here for investors, though. I can promise you the macro data. Let's say I knew every single data point for the next 3 to 6 months. I could give it all to you. We'd still get the market call wrong, because the market and the economy are two completely different things. In the equity market, it's dominated by big cap tech. In the credit market, it's dominated by a price-insensitive buyer, sending a really strong signal we're here to keep financial conditions loose. What does the economic data actually mean to an investor right now?
I'm not sure you can read a tremendous amount into the economic data right now. I think you're going to have to kind of look through that a little bit, look further out into where you think we're going to end up, probably in the beginning of 2021, and base your investments on that. Lisa was just talking a little while ago about that bifurcation between the equity markets and the fixed income markets. You've got these really low rates that are going to deter some fixed income investors because you're just not getting enough return on some of that, but yet it's driving that equity market. So we've got to look for those trends that we think are going to happen, whether that's 5G, cloud, data infrastructure. Those are the areas we're looking for. We saw the big 4 tech names that you've been talking about all morning. They crushed it this last quarter. We think they're going to continue to do that as we go into the beginning of next year. And investors in the markets are really kind of looking through the earnings season because we know that it's going to be poor. So I think you have to, the market is responding not just to what's happening now, it's responding to where it thinks we're going to be 2 quarters from now.
Well, let's put the performance on the screen of big cap tech this morning going into the opening bell and over the last year and off the bottom as well. I just wonder where you need to be braver, Victoria. Was it harder to be long these names in March, or is it harder to pivot away from them in July?
I think for many people, it's going to be harder to pivot away now. But I will tell you that's actually what we've been doing. We've actually trimmed some of these names. We trimmed our Apple position. We trimmed our Microsoft position over the last couple of weeks and rotated into some more of those staple names, McCormick, Walmart, even into JP Morgan. I know you were saying earlier, how can you invest in the banks? But we think that there's potential there, especially in a name like JP Morgan, and even into some of the broadband plays like Charter Communications. So it doesn't hurt to take a little bit off the table with the run that we've seen, but because people love to go with that herd mentality, and because we saw such strong earnings, I think that's going to be difficult for some people to do, but it might be the best thing for your portfolio.
Victoria, right now, 2-year rates, 11 basis points in the United States. Is that not going to be a huge, huge overhang for the banks in America?
It is going to be a huge overhang, but we also saw that for the banks, trading was a huge component, not just in U.S. banks, but what we saw in some of the European banks as well. We actually saw trading some of the biggest components of some of the oil companies that have reported. So I think that part of the business is going to continue to help banks. We hope that we're going to come out of this COVID dilemma probably in the next 2 quarters, 3 quarters. And if so, maybe rates start to move a little bit higher. We know we're anchored towards that 0 for the next couple years with the Fed, but the longer part of the curve should start to move a little bit higher. That should help some banks.
If you're barbelled, as many people are looking to have that strategy, Victoria, on the one side, you've got that cyclical exposure into financials. What do you put on the other side?
Well, you do have to have that diversification. And look, we're overweight tech at this point in time, so we have that secular growth component in our portfolio, but we just don't think you need to put all your eggs in that basket. So yeah, add a little bit to your staple component, add a little bit to the discretionary component. You don't have to go all in on these, but go ahead and spread that out a little bit. Find those companies that have the strong balance sheets that you know are going to be able to make it through any kind of volatility that we have, because look, it's not just COVID. COVID. We've got the election coming up. We've got trade issues. We've got China issues. So there is going to be quite a bit of volatility. We can use that in our option strategy. You can use it in a dividend strategy. So find other places to put some of your funds. You don't have to go all in on the tech names.